right, the market punked me again. I thought yesterday, Jerome Powell came out, increased interest rates by 75 basis points. I thought it was pretty calming, took some uncertainty out of the market, and the market rallied, and I ended up covering a lot of my downside bias positions. And I thought that we might have gotten a follow through and perhaps some intermediate bounce higher. And I was wrong. Severely wrong. NASDAQ is down 4%, S&P is down 3%. So, yeah, there's that. And I went into the day with a lot of long upward bias positions. So, yeah, I'm not having a great. All right, so let me show you something that I worked on today. I'm going to talk a little bit about point and figure. Let me open this up. Let me get myself out of the way. All right, so this is a point and figure chart, right? Columns of X's and O's. And this is filtered price movement. You notice here along the bottom is years, but it's not symmetrical time period, right? So it takes out the time factor. X columns represent rising prices, O columns represent the falling prices. Each box represents a specific value. This is a 3-box reversal method, and it takes a unique look at the price action, right? So it filters for insignificant price moves. So it factors it filters for insignificant price moves and noise. It focuses on the importance of the price movement, and it removes the time aspect from the analysis, as we mentioned. And it makes support and resistance levels easier to identify. So this is point and figure. Basically, the way you read this, if you take a look at the O's, which represents a down market, if the next O is lower than the previous O, we're in a bearish formation, right? So we've been here. You can see here this X was higher than this X. So very brief bullish formation here, but for the most part, through the month of May into now, it's a bearish formation. One thing I look at here is so this is the percent of the companies in the S&P 500 that are in a bullish PNF pattern. And you can see right here, only 13.2% of the companies actually have a bullish pattern. This is an extreme level, and you can see I went back here. How long back am I going? This is 20 years. So anytime that this PNF or the bullish percentage figures drop below this 20% mark, and I highlighted that by these circles here, you can see it mostly represents a major market bottom and a buying opportunity, right? So you can see it here, 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 and this is where we are now. We just got down to this level. And I found this interesting because when I go back and I run this analysis, so I'm looking at this metrics here and I ran this analysis. So I went back in time and I calculated every time that percent of the companies in bullish PNF formation occurred. It happened 74 times over the history. I went back like 30 years. So of the 74 observations, in 1 year, the 1 year return, the market was profitable 63 times and unprofitable 11 times. So there was a profitability ratio of about 85%, or an 85% probability that the market would be higher over the coming year when the PNF is, the percentage PNF is less than 20. And if you take here, look at here, the average annual return for the S&P 500 coming out of a minus 20% PNF, the average return is about 27%. This is compared to an average when it's above 20 of about 9%. So you can see here the alpha, which is the difference between the two, is about 18%. So at a percent bullish PNF at less than 20 gives me comfort in that the S&P 500 will be higher, significantly higher, within a year from now. This is another one. So this is the percent of the companies in the S&P 500 that are trading below their 200-day moving average. So you can see we're sitting 13.4% of the companies in the S&P 500 are above their 200-day moving average. So you can see every time this number drops below this 20% range, highlighted by these green areas, you can see usually represents a pretty good buying opportunity. and that's where we are now. So I went back and I did this analysis, and going over the history, again, it was like 30 years or so, I noticed 265 observations where the percent of the companies below their 200-day above their 200-day moving average was less than 20%. So of the 265 observations, 243 of the times the market was higher a year later. That's about 91, call it 92% of the time. And not only that, the average annual return when the percent below the 200-day moving average is less than 20, the average annual return for the S&P 500 was 27.1% versus 8.3 when it was above the 20% level. So that represents alpha of about 19%. So I'm optimistic on the very, very long end of this cycle. So here's the S&P 500. I had bought long calls, and these are outdated. I'm going out a year now. So you can see here the market, the S&P 500 into the SPY is getting beat up. I bought calls on the SPY going out a while, anticipating that this market a year from now is going to be much higher than it is now. Basically, my profitability, my profit center here is about 408, and as the SPYs right now are at around 367. So it's about 11%. So if the market goes up 11% or more over the next year from this level, I should be able to make money. And I feel good about that 11% because if you take a look at here, the average annual returns when these indicators are flashing is like I said, 26, 27%. So I feel pretty good that we should be able to make money with these. So let's see what we did. All right, so here are the SPYs. I went long the calls. These are the June 16th, 2023 expiration. $370 strike price. I bought them for $37.94. I put at risk about $38,000 on this trade, which is a little bit bigger than I normally would, but considering this is such a longer term event, I feel pretty good about it. I think it's a high probability trade, so I went a little bit more aggressive than I normally would have. Right, so I'm anticipating that a year from now the market's going to be up greater than 11% from this level here. So that's my bet on that trade. Unwound a couple of positions today. Let's go through that. I had this bear put vertical for KMX, that's CarMax, right? And I closed them out today. So we put this on May 10th, and I had sold the July 15th 92.50 puts for $7.65. I bought the July 15th puts, $95 strike price for $8.85. I unwound them today, and I took about a 26% gain on that trade. So this is Apollo Group. This is the one where I thought I was going to lose all my money. Ended up closing out half of it on the 13th. Today I closed out the remainder of it. So here on May 26th, I had sold the July 15th puts, $47.50 strike price for $1.01. And I went ahead and I bought the July 15th 52.50 puts for $2.35. I unwound them today, made about 49% return on this trade. All right, this is Nike. I had put this bull call vertical on it, and yeah, it's not happening. So I got out of it today for a loss. So you see here on May 31st, I had sold the July 8th 120 calls for $4.04. I had bought the July 8th calls, $115 strike price for $6.55. I sold them today, or I unwound this vertical today. I ended up losing 56% of my money on the trade. Okay, here is AGL. I was long puts in this one. I sold half of them. I sold half the position on the 14th, on June 14th. Took a little bit of a profit there. And then today I got out of the rest, closing the position out of its entirety. So I had bought the June 17th puts expiring this Friday, so I was running out of time, so I had to get them out. So these are the June 17th puts, $20 strike price. I bought them for $1.75. I ended up selling the rest of the position today for $2. So I made about 14% here. So this is EBIX. Now I made a mistake the other day. This was on the 13th when everything was coming in on Monday. I had said that I had taken profits in EBIX, and that wasn't the case. I actually only took half off. and I had the other half remaining. So when I came in today, I saw this huge gain there with the company, and I was like, oh, I only took half off. So I ended up closing EBIX today in its entirety. So yeah, take a look at EBIX right today. Stock is down 43%. I'm so happy I didn't sell the entire thing. I thought I did, but today I came in, I saw this huge gain in the portfolio. I was like, what the fuck is going on with this? So yeah, this stock is down 43%. So there was a big short seller report out saying that these guys are somewhat cooking the books. And I'm getting filled on something over there. So yeah, short seller came out, accused them of cooking the books, and the stock just absolutely plunged. So on May 31st, we had bought the July 15th puts. These are the $25 strike price. We paid $1.90 for them, and today I sold the remaining position for $9.52. That represents about a 401% return. So huge gain there. Really helped my P&L. Here's on Semiconductors, ticker symbol ON. Here on June 1st, we had bought puts. So we went long the September 16th, $60 strike price puts. We paid $6.80. Today I got out for $8.80. Represents about a 29% return on the trade. All right, this is PLTK. I have an order in there to sell. I got some of it done. I got about a third of it off. So here, the PLTK, we had, this was on June 2nd, we had bought the August 19th puts. This is the $12.50. This is the $12.50 strike price puts, and we paid $1 for them. And today I sold about a third of the position for $1.30, so that represents about a 30% return on the money. Here's Callaway Golf, ticker symbol ELY, E-L-Y. On June 3rd, we went long the puts here. I had bought the July 15th. $20 strike price puts, and I paid 65 cents for them today. I got out for $1.20. That's about an 85% return on the investment there. All right, so that's basically what I got. Market punked me today. I'm surely going to be taking some losses later on this month. All right, that's what I got. I'll see you later.